My dear students, welcome back to our channel. In this video, I will be explaining the BBA 5th semester subject Financial Markets and Services as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 2 first important short question is: what do you mean by book building? Book building. Book building is a method used in the primary market to decide the final price of shares when a company issues an IPO. Instead of fixing one price, the company gives a price range, for example, 90 rupees to 110 rupees. Investors then tell how many shares they want to buy and at what price within this range. This process is called bidding. When all bids are collected, the company checks at which price most investors are willing to buy. That price becomes the final issue price, called the cut-off price. Shares are then allotted to investors based on this cut-off. Simple example. Suppose a company offers shares in the range 90 rupees to 110 rupees. Investor A bids at 100 rupees. Investor B bids at 110 rupees. Investor C bids at 95 rupees. If most bids come near 105 rupees, then 105 rupee will become the final price. Why is book building useful? It helps find a fair market price. Reduces chances of overpricing or underpricing. Attracts more investors. This method makes IPO pricing more transparent and reliable. Next important short question is: 2. What is free pricing? Free pricing means companies are free to decide the price of their shares when they issue them in the primary market. Earlier, in India, the government used to fix prices for public issues. But after reforms, companies can set the price on their own based on demand, financial performance, and market conditions. In free pricing, the company studies its profits, assets, and growth, the value of similar companies, investor demand. Then it fixes a price that it feels is fair. Simple example. If a company feels that its business is strong and investors will show good interest, it may decide to issue shares at 150 rupees. Another company with lower profits may issue shares at 60 rupees. No government rule controls this price, the company decides. Why is free pricing important? Companies get more flexibility. Helps raise funds faster. Investors get shares at a market-based price. This makes the Indian stock market more open and competitive. Next important short question is: 3. Online IPOs. Online IPOs mean applying for a company's initial public offering, IPO, through the internet without using paper forms. Investors can apply using their bank account, Demat account, and trading account through websites or apps of banks and stockbrokers. Instead of standing in queues or submitting physical forms, investors can fill the IPO application online in just a few minutes. How it works? 1. Log into your net banking or broker app. 2. Select the IPO you want to apply for. 3. Enter the number of shares and price. 4. Money gets blocked through ASBA, application supported by blocked amount. 5. If you get shares, the money is deducted, if not, the money is released. Simple example. If Reliance launches an IPO, you can open your SBI YONO, HDFC, Zerodha, or Grow app and apply directly with one click. Why online IPOs are popular? Fast and paperless. Safe and transparent. Easy tracking of application. No middlemen or extra charges. This method makes investing convenient for all Indians. Next important short question is 4. NSE. NSE stands for National Stock Exchange, the largest and most modern stock exchange in India. It started in 1992 to bring transparency, speed, and technology into the Indian share market. NSE was India's first fully electronic stock exchange, meaning buying and selling of shares happens through computers, not on the trading floor. Key features of NSE: fast and fully automated trading system. National level reach, investors from any city can trade. Safe and transparent prices. Strict rules to protect investors. NSE's main index is Nifty 50, which shows the performance of 50 major companies like Reliance, TCS, Infosys, HDFC Bank, etc. Simple example. If you open a trading account on Zerodha, Grow, Upstocks, or any broker, most of the trading you do, whether buying TCS or selling Infosys, happens on NSE. Why NSE is important? It makes trading quick, fair, and accessible, helping even small investors participate in the Indian stock market easily. Next important short question is 5. Explain OTC. OTC stands for Over-the-Counter Exchange of India. It was started in 1990 to help small and medium companies raise money by selling their shares. These companies were often too small to list on big exchanges like NSE or BSE, so OTC gave them a special platform. OTC was India's first screen-based trading system where buying and selling happened through computers, not in a physical trading hall. It worked like a shop network. Investors could visit OTC counters in different cities to trade shares. Simple example. A small electronics company that cannot meet BSE's listing requirements could list its shares on OTC. Investors visiting OTC counters could buy these shares easily. Why OTC was created? To support small companies. To give investors more choices. To promote transparent and computerized trading. Although OTC is not very active today due to the rise of NSE and BSE, it played an important role in modernizing India's trading system. Next Unit 2. Long questions. First important long question is: what is primary market? Explain its features. Primary market. The primary market is the market where new securities, shares, debentures, bonds are issued for the first time by companies. When a company needs money for expansion, new projects, or to repay loans, it raises funds by selling shares to the public through the primary market. This process is called a public issue or IPO, initial public offering. You can remember it simply. Primary market is equal to first-time sale of shares directly by the company to investors. Features of the primary market. 1. New issue market, first-time sale. The primary market deals only with new shares. These shares were never traded before. Example, when Zomato launched its IPO, shares were sold for the first time through the primary market. 2. Funds go directly to the company. In this market, the money investors pay for shares goes directly to the issuing company, helping it raise capital for growth. 3. Different methods of issuing shares. Companies can issue shares through IPO, initial public offer, rights issue, private placement, bonus issue to existing shareholders. This gives companies flexibility in raising funds. 4. Strict regulation by SEBI. To protect investors, SEBI checks company documents, financial statements, transparency, proper disclosure. SCBI ensures the issue is safe and fair. 5. No trading, only issuing. The primary market does not involve buying and selling between investors. Once shares are issued, they get listed on stock exchanges, NSE, BSE. After listing, they move to the secondary market for trading. 6. Price determination. Companies may decide the price through free pricing, company decides. Book building, price discovered through bidding. 7. Involvement of intermediaries. Merchant bankers, underwriters, registrars, brokers, and bankers help in the process to ensure smooth issue and allotment. Simple example to remember. When LIC launched its IPO, people applied through banks or apps like Zerodha. The money went to LIC. Once the shares got listed on NSE, BSE, investors started buying and selling them in the secondary market. This first step, selling new shares, is the primary market. The primary market is the starting point of investment, helping companies grow and investors participate in their future success. Next important long question is: to explain the concept of e-prospectus. E-prospectus. An e-prospectus is an electronic version of a prospectus. A prospectus is a legal document that a company must publish when it issues shares to the public for the first time. It contains all important details about the company so that investors can make safe and informed decisions. An e-prospectus simply means the same document available online in a digital format instead of a printed booklet. You can remember it easily. E-prospectus is equal to prospectus on the internet, paperless and easy to access. What does an e-prospectus contain? An e-prospectus includes company background and history, promoters and management, financial statements, profits, assets, debts, etc. Purpose of raising funds, risks involved, price of shares and number of shares offered, rules for applying in the IPO. Everything is the same as a printed prospectus, only the format is digital. Where can investors find an e-prospectus? It is available on company's official website, SCBI website, stock exchanges, NSE, BSE websites, merchant bankers and brokers websites. This makes it easy for anyone across India to read full details before investing. Why is an e-prospectus important? 1. Easy access, anytime, anywhere. Investors do not need to visit offices or collect paper copies. Just one click full information. 2. Saves time and cost. Companies save printing and distribution costs. Investors save effort. 3. More transparency. All details are clearly displayed online, reducing chances of fraud or hiding information. 4. Useful for online IPO applications. When applying through net banking or broker apps, the e-prospectus is available for easy reference. 5. SCBI requirement. SCBI made it compulsory to publish an electronic version so that all investors get equal information. Simple example to remember. Suppose Tata Technologies is launching an IPO. You open the Zerodha app, click the IPO section, you can see a button called View Prospectus. When you tap it, a PDF opens with all details of the company. That PDF is the e-prospectus. An e-prospectus makes investing safer, transparent, paperless, and convenient, especially for India's growing online investors. Next important long question is: 3. What is secondary market? Explain its features. Secondary market. The secondary market is the market where already issued shares are bought and sold among investors. Here, the company does not receive any money. Instead, one investor sells and another investor buys. This trading mostly happens on stock exchanges like NSE and BSE. You can remember it simply. Primary market is equal to first sale of shares. Secondary market is equal to everyday buying and selling of shares. After a company completes its IPO in the primary market, its shares get listed on stock exchanges. From that day, those shares start trading in the secondary market. Features of the secondary market. 1. Trading of existing securities. Only already issued and listed shares are traded here. Example, after Zomato listed its shares, people buy and sell them daily in the secondary market. 2. Provides liquidity. Investors can convert shares into cash anytime by selling them in the market. This makes investing safe and flexible. 3. Operates through stock exchanges. NSE, BSE, and OTC are major platforms where trading takes place. These exchanges provide technology, rules, and a transparent system. 4. Prices change every moment. Share prices fluctuate based on demand and supply, company performance, economic news, investor sentiment. This creates opportunities for profit. 5. Regulated by SEBI. SEBI ensures fair trading, prevents fraud, and protects investors. It monitors brokers, stock exchanges, and all market activities. 6. Quick settlement system. Today, India follows T+1 settlement, which means you get your shares or money within one working day. 7. Involves intermediaries. Brokers, depositories, NSDL CDSL, clearing corporations, and banks help complete trades safely. Simple example to remember. Imagine you bought shares of Infosys after its IPO. Next week, you decide to sell them at a higher price. This buying and selling among investors, not the company, happens in the secondary market. The secondary market is the heart of the stock market, providing liquidity, fair pricing, and opportunities for investors to grow their wealth. Next important long question is 4. Examine the trading and settlement process in detail. Trading and settlement process. In the secondary market, buying and selling of shares happen through a trading and settlement system. Trading is the process of placing orders to buy or sell shares, and settlement is the actual exchange of money and shares between the buyer and seller. 1. Trading process. Trading in India mostly happens on stock exchanges like NSE and BSE using a fully electronic system. Here's how it works. 1. Investor places an order through a broker or online trading app. You choose the stock, quantity, and price. 2. Order goes to the exchange. All buy and sell orders are matched electronically. 3. Order matching. The exchange matches buyers and sellers based on price and time priority. 4. Trade confirmation. Once matched, the trade is executed, and both buyer and seller get confirmation. Example, you want to buy 10 shares of Reliance at 2,500 rupees. A seller is ready to sell 10 shares at 2,500 rupees. The exchange matches the order, and the trade is executed instantly. 2. Settlement process. Settlement is the process of transferring shares to the buyer and money to the seller. In India, settlement follows the T+1 or T+2 system, trade date plus 1 or 2 working days. Here's the step-by-step process. 1. Clearing. the exchange's clearing corporation calculates the net amount of shares and money each broker must pay or receive. 2. Transfer of shares. Shares are electronically transferred from the seller's demat account to the buyer's demat account via NSDL or CDSL. 3. Transfer of money. Money is transferred from the buyer's bank account to the seller's account. 4. Completion. After both shares and money are exchanged, the settlement is complete. Example: if you sell 10 Infosys shares at 1,500 rupees, the shares move from your demat to the buyer's demat, and 15,000 rupee gets credited to your bank account within 1 to 2 days. Key points to remember. Trading is equal to placing and matching orders. Settlement is equal to actual exchange of shares and money. Fully electronic system, fast, transparent, and safe. SCBI regulates the entire process to prevent fraud. Demat accounts and brokers are essential for smooth trading. Remember, trading is equal to deal happens on the screen. Settlement is equal to deal becomes real with shares and money exchanged. This system ensures quick, secure, and fair transactions for every investor in India. Next important long question is: 5. SCBI plays an important role to strengthen stock markets. Explain. SCBI. SCBI, Securities and Exchange Board of India, is the regulatory body that controls and supervises the Indian securities market. It was established in 1988 and given statutory powers in 1992. SCBI's main aim is to protect investors, ensure fair trading, and develop healthy stock markets in India. You can remember it simply. SCBI is equal to market police plus market teacher. 1. Protects investors. SCBI ensures that investors get correct and complete information about companies before investing. Companies issuing shares must provide a prospectus or e-prospectus with all financial details. SCBI prevents frauds, insider trading, and misleading advertisements. Example: if a company hides its losses while launching an IPO, SCBI can stop the issue or punish the company. 2. Regulates stock exchanges. SCBI monitors major stock exchanges like NSE, BSE, and OTC. It ensures that trading rules are followed and orders are executed fairly and transparently. Example: NSE uses electronic trading, and SCBI ensures no one manipulates the prices. 3. Promotes transparency. SCBI requires companies to disclose their financial statements regularly. Investors can easily compare companies and make informed decisions. Example: quarterly results of TCS or Reliance are available on NSE, BSE, and SCBI websites. 4. Develops the market. SCBI introduces new financial instruments like derivatives, mutual funds, and ETFs. It also promotes internet trading and online IPO applications, making investing easy and convenient. 5. Ensures settlement and safety. SCBI oversees trading and settlement systems. Demat accounts, clearing corporations, and brokers operate under SCBI rules to prevent delays and fraud in share transfers. Simple example to remember. When you buy Infosys shares online, SCBI ensures your broker is registered. The share price is fair. Your money and shares are safely transferred. Without SCBI, trading could be risky, unfair, or fraudulent. Key points. Protects investors from fraud. Regulates exchanges and brokers. Ensures transparency and disclosure. Promotes online trading and new financial products. Safeguards settlement process. Remember, SEBI acts as a guardian, teacher, and developer of India's stock market, making it safe, transparent, and investor-friendly.